So the big five financing America's 34 trillion in debt are Japan with 1.1 trillion. China has something like 750 billion. United Kingdom's got 690 billion, Luxembourg 373 billion, and Canada 329 billion. So they're investing in the US, or at least they're paying for our bills. So foreign countries hold about 22, 23% of our IOUs. They're like the friends that still buy you rounds at 2 in the morning. Now, yesterday or this week's tariffs announcement was economic chaos theory in action. So we're taxing the same countries that were begging to buy our debt. And it's always about cash when you look at this. Now, with China, we hit them with tariffs. Now, they finance us with dollars from trade surpluses. If there's fewer exports to the US, that means there's fewer dollars to buy US treasuries. This is a reminder. Trade wars aren't good and easy to win. They're complex, messy, and the financial equivalent of like lighting your house on fire because you don't like your neighborhood's paint color. US has been able to run big deficits because the dollar is the world's reserve currency and playing the game on easy mode. But if you end it, well, tariffs could accelerate that de-dollarization and the game for us gets harder. It means basically money gets more expensive, mortgage rates go up. So could this stuff create a treasury shortfall? But here's where it gets interesting. If foreign buyers tap out, we have a couple of options. The Fed could step in and print money, or domestic buyers could kind of fill the gap, but that money comes from the stock market, moves to other spots. You could also raise rates to attract capital. All three of those things mean higher costs, and it's an economic drag in the economy. There's no free lunch. Now, economic dominoes could start to fall too. You could see retaliation. Countries that get hit with tariffs could hit back. And that means that US exports suffer. Export industries lay off people and fire them. Tax revenue would fall from that. Debt servicing gets harder. It's like expecting somebody to loan you money right after you punch them in the face. And in markets, what we're seeing, they hate volatility. These tariffs are uncertainty for everybody. The dollar could strengthen, although it's weakening right now. If the dollar strengthens, our exports become less competitive. Foreign currencies could weaken, making the US debt more expensive to service. You're going to see the dollar go up and down in value as all kinds of crazy things happen. Now, these tariffs themselves are a tax on consumption. If there's higher prices, you see less spending, you see slower growth, and you see less tax revenue. The economics isn't really that complicated. Now, countries might start shifting from treasuries to gold or other currencies or commodities. The dollar's reserve status doesn't guarantee eternal loyalty. These things can change quickly. Foreign holders of US debt have been trending down, and the tariffs are going to accelerate this quite a bit. Not ideal when we have $1 trillion deficit to finance. Now, the real question is, can the US government finance itself without foreign buyers? Yes, it can, but at a high price. You end up with higher rates, higher debt service costs. That means less money for everything else. Fiscal policy here is about trade-offs. So we're risking our ability to cheaply finance $34 trillion or so in debt to score political points in trade. It feels good now, even though it hurts, and it's more painful later on.